Very good evening to Madam and my friends. So today we're gonna present about stock price index in Japan on what are the variables that contribute for the movement of the stock price index Nikkei 225. So we have me, Ashril, Umar, Kit, Jonas, and also Imran here. So without further ado, so let's present and analyze the contribution of the variables towards the stock price index Nikkei 225. Over to you, Kit.
Australia. So hi madam everyone, my name is Jike. So today I will present our group business finding. Our study focus on to determine the relationship between the Q oil price and Nikkei 225 stock price index and determine the relationship between the exchange rate in USD for Japan and Nikkei 225 stock price index. The third will be to determine the relationship between 10-year Japanese government bond rate and Nikkei 225 stock price index. Next will be data source. Basically, all the variables such as the stock price index, Q oil price, 10-year Japanese government bond rate, and exchange rate were obtained from the investing.com. And, and we are using a monthly data from January 2020 to 31 October 2024. And we are using 58 number of data. So there is a part for me. Next, I will pass to Stu.
Thank you, Kit. So the first variable that we identify to have a relationship with stock price index is crude oil price. So basically what we did is we go for a journal review and then we read some of the journal, and then this is what the relationship that we anticipate to have the crude oil price with the stock price index. So first of all, it's going to have a positive impact. And then after we digging some another journal also by Killian and Park 2009, we anticipate that it's going to have the negative impact. So yeah, I will pass to Jonas.
Yeah, so thank you, Astrid. My name is Jonas, and I'm going to talk about the impact of exchange rate towards Nikkei 225 stock price index. So the connection between the USD JPY exchange rate and the Nikkei 225 stock index is crucial to Japan's economy. So after reading some journals, we come out that when the yen weakens against the dollar, Japanese exports become cheaper and more competitive globally. So this helps export-focused companies earn more and pushes their stock prices higher. So research from Korea show that exchange rate impact company profits, while Foma and French found that weaker exchange rate boost stock markets in export-heavy countries such as Japan. Okay, so next. So for the next one, Japanese government bond yields also play a key role. So higher yields often signal tighter monetary policies, which raise borrowing costs and reduce corporate profits. This put pressure on the stock prices. Additionally, high yields can indicate weak economic conditions, further hurting the market. So we found that the data from the Bank of Japan and Bloomberg, it shows that there has a strong negative link between bond yields and the Nikkei 225 with a beta of negative 1.5. And next. So other factors like oil prices also influence the Nikkei 225. Japan relies on energy imports, so changes in oil prices can be broad effect. While higher oil prices often lead to inflation, the impact depends on investor sentiment. Among these factors, bond yields and exchange rates are the most consistent drivers. A weaker yen boosts stock prices by helping exporters, while higher bond yields hold the market back to the tighter financial conditions. So for the next part, I'm going to pass it back to Ashriel.
Thank you, Jonas. So after that, we did the literature review. We have come up with the econometric model. So we have ln SPI equal beta 0 plus beta 1 ln COP plus beta 4 ln COP to the power of 2 plus beta 2 bond yield plus beta 3 long exchange rate plus epsilon t. So the T here indicate the time series because we are using the data spanning from 1st January 2020 until 31st October 2024. The SPI here indicates the stock price index, right? And then for the crude oil price, based on the literature review, we anticipate that the sign of the beta coefficient for the crude oil price will be negative. For the crude oil price to the power of 2 will be positive, which is the normal U shape. And then for bond yield, it's going to have a negative relationship, negative sign. For the exchange rate, it's going to have positive. And also, these are the expected sign of the coefficient based on the literature review that we did earlier, based on here. The literature review on the crude oil price, the exchange rate, and also bond yields, right? So after we have done some for the expected sign of the coefficients and the econometric model, and then we use that data that we get from the January until the October of 2024, and then we run in the eViews, and then this is what we have for the estimated regression model. So after we run in the eViews, this is what we get, and it's not similar to what we expected, right? So as you can see here, we have negative. This is aligned with what we expected, and also positive in the long COP to the power of 2. However, for the bond yield and exchange rate is the other way around, right? So after we run for this estimated regression model, only we can go for all the tests to see whether all the classical assumption, the 7 classical assumption is met. So I'll pass to Jonas to talk about the test for the error term. Over to you, Jonas.
Okay, so thank you, Austria. So from an econometric perspective, the error term normality test confirms that the data is normally distributed at a 5% significant level. And this conclusion is being supported by the jump-barrier statistic. But however, the Lagrange multiplier test identifies second-order serial correlation in the model, signaling that additional factors may need to be considered for improved accuracy. Next. So for the t-test is conducted for crude oil prices, and the square terms shows that there are no significant impact on the Nikkei 225, indicating that oil prices may not currently be a primary driver. However, based on the review of the literature, we expected crude oil price to have a negative relationship with the Nikkei 225, while their square terms would demonstrate a positive relationship. Okay, so for the next part, I'm going to pass it to Kit.
Thank you, Jonas. So in this slide, we can see that the bond rate, it showed the T statistic 7.73, which is greater than the T critical of 7.67. So we know that we are going to reject the new hypothesis. It shows the negative relationship with the SPI at 5% significance level. Similarly, for the exchange rate, it showed the T statistic 2.635, which more than the T critical value of 5.671. So we are reject the HO. It show a positive relationship with the SPI at 5% significance level. So next.
Okay, so next in the F statistic is 60.04 is greater than the F critical value of 2.53. So we reject the HO. This showed that at least one of the variable significance affect the Nike 225. Similarly, in W Watson DW test, we reject the reject hash O because the D statistic is 0.8411 is less than the critical value of 1.25. This indicates that there is a positive series correlation at 5% significance level.
So through the Bruce handgun test, the table, we know that we did not reject the null hypothesis because the BP statistic is 3.68 is lesser than the critical value of 7.81. This indicates that the error term is homoscedastic or has a constant variance at 5% significance level. Similarly, in the white test, we did not reject the HO because the white statistic 12.36 is lesser than the critical value of 16.92. This confirms that the error term is homoscedastic at 5% significance level. So next, I will pass to Uma.
Thank you, GK. So let's now examine the correlation matrix to understand the relationship between our key variables. So in the crude oil price and line crude oil price square, we have a perfect correlation, which is 1.00. This indicates multicollinearity between these variables since crude oil price square is likely derived from line crude oil price. So basically, the bond yield has a strong positive relationship with exchange rate at 0.8972. Next. So to assess the severity of the multicollinearity, we turn to the various inflation factors, which in land crude oil price and land crude oil price square, both have extremely high VIF values, which is more than between 190 million, confirming severe multicollinearity. Also for the bond yield, which have a VIF of 5.05, indicating moderate multicollinearity. Lastly, land exchange rate, which is 6.28 for various inflation factors, which indicate moderate multicollinearity. Next. So after that, we conduct the Ramsey test to check our model specification. So based on the test, we conclude that the 3.1828 is lesser than our critical value, which is 2.53. So we reject the H null, suggesting that the model is misspecific at the 5% significance level. Next, I will pass to Nabil.
All right, thank you, Omar. So this is for the classical assumption. So for the classical assumption, so we're gonna see on whether all the classical assumption is already met or violated. So for the classical assumption 1 is the model is linear. Yes, the model is linear based on the econometric model just now. And then is it correctly specified or not, and includes an additive error term? Yes, we have epsilon. All right. But for the Ramsey reset test, we can see the model is misspecified because the F statistic is greater than the critical value, which is 3.1828 is greater than 2.53. So we reject the hash null. So this is clearly stated that the model is misspecified, right? So the result is violated for the classical assumption 1. For the classical assumption 2, the error term has a zero mean, right? So our result is violated, right? The significant constant term suggests that the error term may not have a zero mean, but further diagnostic tests are required for conclusive evidence. So to achieve a zero mean, we need a large sample, which we only have 58 samples, number of data. right? To achieve the error term has a zero mean, we need a bigger sample. Okay, and then for the classical assumption 3, all explanatory variables are uncorrelated with the error term. Result is violated. This is proved by the Darwin-Watson and also the LM test, okay, which is indicate a positive serial correlation in the residuals, and suggesting that explanatory variables are correlated with the error term, right? And then for the classical assumption 4, observations of the error term are uncorrelated with each other. The result is violated. Same also with the classical assumption number 3 just now, because the Darwin-Watson and also LM test indicate that it's a positive serial correlation, and meaning the error terms are correlated, right? And then for the classical assumption number 5, the error term has constant variance, homoscedasticity. The result is MELT based on the BP test and white test just now. It indicates that the error term has constant variance, which is we fail to reject the hash null, which is the has constant variance, which is no heteroscedasticity. And then for the classical assumption number 6, no explanatory variable is a perfect linear function of any other explanatory variables, which is violated based on the VIF just now, and also based on the bond yield and also the exchange rate. We have a moderate multicollinearity for bond yield and also exchange rate. And then last but not least, for the classical assumption number 7, we have the error term is normally distributed. Result is MELT based on the Jabera, the first test just now, the normality test. Based on the Jabera test, it shows that the error term is normally distributed. So after all of this classical assumption that we did and everything, so we, as a policymakers, we need to know what the policymakers can do. So I'll pass to Nabil Imran to explain more about that.
Hi, thank you, Asher. All right, so I will be discussing how Japan can navigate the economic fluctuations, particularly focusing on the Nikkei 225 stock index. All right, so the first one is by managing the crude oil price volatility. So the volatility of crude oil prices presents a dual challenge for the Japanese economy. While higher oil prices boost the energy sector, they also escalate costs for other industries, reducing profitability and investors' confidence. To mitigate this risk, Japan must adopt these following strategies. So the first one is by diversifying their energy sources. How they can diversify their energy sources is by investing in renewable energy such as solar and wind power. This can reduce its dependence on crude oil imports and limit its exposure to global price shocks. Additionally, advancements in nuclear energy can provide a stable energy supply and strengthen the economic resilience. So another crucial approach is by maintaining the strategic petroleum reserves. So by effectively managing these reserves and strategically releasing oil during periods of high price volatility, the government can cushion the economy from external shocks and minimize disruptions in the stock market. So the third one is by encouraging energy efficiency in industries. So the government can offer subsidies and tax incentives to companies adopting energy efficient technologies. This not only enhances industrial competitiveness, but also mitigates the negative impact of fluctuating oil prices and the stock market. Next slide. Next slide, please. All right, thanks. Okay, so the next one is optimizing monetary policy for bond yield management. So bond yield movements significantly impact investor confidence and stock market performance. A positive correlation exists between Japanese government bond yields and the Nikkei 225, where rising yields often signal economic strength. So to ensure a balanced financial environment, policymakers should consider some of these following measures. So the first one is yield curve control. Yield curve control remains a vital tool for stabilizing borrowing costs and fostering economic growth. The Bank of Japan should continue to fine-tune this approach in response to global interest rate, maintaining investor confidence while ensuring sustainable economic expansion. The next one is by issuing inflation-linked bonds. By issuing inflation-linked bonds, it can attract investors seeking for protection against inflation, thereby stabilizing bond markets without leading excessive yield increasement. This policy ensures a stable investment environment while maintaining equilibrium between debt management and stock market growth. And the third one is communication and forward guidance. So a clear and transparent communication regarding monetary policy is very essential. Forward guidance from the Bank of Japan helps to reduce market uncertainty and enhance investor confidence. When the investors understand the central bank's inflation control strategies, they respond more positively, thus minimizing the adverse effects of bond yield fluctuations. Next slide. So the last one is stabilizing exchange rate movements. So the Nikkei 225 stock index has a strong positive relation with the USD JPY exchange rate. While a weaker yen boosts Japan's export-driven sectors, excessive volatility can destabilize the economy and discourage foreign investment. To promote exchange rate stability, the following strategies are recommended. The first one is intervention in forex market. The Bank of Japan and the Ministry of Finance can take action during periods of excessive depreciation or appreciation, ensuring that the currency movements do not disrupt market stability. Coordinated interventions with other central banks can also further reinforce these efforts. The second one is promoting trade agreements. So by this, strengthening trade agreements can help expand bilateral and multilateral trade partnerships. The second one is promoting trade agreements. So expanding bilateral and multilateral trade partnerships will enhance the competitiveness of Japanese exports and create stable demand for Japanese products. By reducing trade barriers, exchange rate stability can be maintained, supporting long-term stock market growth. And the third one, hedging support for exporters. So by encouraging currency hedging among exporters, this will promote the use of financial instruments that protect businesses from adverse exchange rate movements. Japan can also help small and medium-sized enterprise to maintain a steady revenue streams and reduce financial risk. So that's all from me. I'll pass back to Uma for the conclusion.
So thank you, Nabil. So to conclude our analysis of the Nikkei 225 stock price index, it reveals three key findings, which is in the bond yields, there is a high positive correlation between bond yield and the SPI stock price index. Higher yields are perceived as a sign of economic strength, which boosts investor confidence and raises market expectations. Next is exchange rate. The exchange rate has a negative effect on the stock price index. A weaker yen increases costs for import dependent Japanese firms, which can lead to lower stock prices. Lastly, for the crude oil prices, which while crude oil price shows no statistically significant relationship with the stock price index in the short run, they remain relevant for energy-related sectors and inflation dynamics. So moving forward, there are important implications and future research direction to consider. So the first one is model improvement. The inclusion of additional microeconomic variables such as inflation, industrial production, and global stock index could enhance the model's accuracy and forecasting capabilities. So next one is advanced techniques. Future studies should address current model limitations such as multicollinearity and serial correlation by employing advanced economic techniques like generalized least square GLS or auto-regressive models. These steps will help us better understand market dynamics and provide more robust guidance for investment decision. That's all for us. Thank you, madam. Thank you, everyone.